And we've arrived. It's the end of the week, and we face the first big piece of U.S. economic data on our sites. It's been a quiet week. Markets got really jumpy on what was not a very exciting jobless claims report today. But it's bigger fish to fry ahead. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to take a look at what is probably the most impactful U.S. data release on this very slow week. And not only because it's one of the only ones of a kind of top tier, the University of Michigan's Consumer Confidence Report. And what we're going to look at here is sort of what it is, why it matters, and how it fits within the overall sort of narrative here. Because we just mentioned the jobless claims numbers. We, of course, got a strong lead from U.S. Employment data last week as well. There is a dynamic that's emerging here. And as ever, it is a Fed-focused dynamic. And so how this particular report, which has been very, very good at giving us bearings on where the Fed is going and how the markets might feel about it for the better part of 3 years, that should be a very interesting and a very different, perhaps, response if all of the dynamics that we've seen continue to hold. So let's first get a little bit grounded in expectations here. This is what we're looking at. What we find is that since about the middle of 2022, consumer confidence has been improving. There's been a steady increase in optimism. And by the way, one interesting thing to note here, this obviously is an index in the center, the sentiment index. It is made up of these two components, the current conditions assessment and the expectations assessment. Notice, consumers tend toward pessimism. Their expectations are usually lower, and current conditions are usually better than their overall sentiment. All of which is to say, consumers structurally tend to underestimate how good they have it and overestimate how bad things are going forward. So that's just a bias to keep in mind here. But notice that the trend has been in the direction of improvement since basically the middle of 2022. And helpfully, within this survey, there's an inflation component where the University of Michigan asks respondents how they feel about inflation and to give their one-year inflation outlook. You'll notice that in the gray bars there is that inflation outlook, and the bottom in sentiment, sort of peak pessimistic sentiment in this most recent cycle, which occurs right here, June of 2022, follows the very next month after there is a peak of inflation expectations by consumers. And as inflation expectations decline, sentiment improves. Note here also that this works even incrementally. So here, there's a bit of a pop in inflation, sentiment cools. It abates, sentiment steadies and improves. There's another pop here for 2 months, sentiment cools. It abates, sentiment comes back, and now, since basically February, is hovering at this 3-year high and not going very far at all because inflation expectations are kind of anchored in this 2.9 to 3.2 range. That's 2.9 down here. This is 3.2 there. The expectation for this report is that we are going to have sentiment continue to hold steady because inflation is going to continue to sit in this range. The expected inflation, 3.1%, is the loose expectation out there. And so no harm, no foul. Everything is steady as it goes here if we look at the forecasts. except if it's inflation expectations that basically are driving consumer sentiment. One thing we know about inflation is that all through the course of April, the data has been decidedly spicy. Here's a quick survey. CPI inflation, hotter than expected, both core and headline. The producer price index, the core, the more important part that the Fed cares about, hotter than expected. I didn't highlight the import price index here because there was no consensus number for it, but obviously a rise of 0.4% marks a very stark contrast from a decline of 0.9% in the prior month. The GDP inflation gauge within the first quarter report, hotter than expected. The PCE gauge, the Fed's favored measure of inflation, hotter than expected. So we had an April here where the numbers continually showed us hotter and hotter and hotter inflation. And of course, this is how going into this most recent Fed policy announcement at the start of May, we ended up with the market saying, are we even going to get rate cuts this year? Maybe not. And then, of course, the Fed disabused them of that extreme a notion and said, look, we still think that rates are in a restrictive space here. We don't need to do anything to hike them. We're also a bit reluctant to cut them because inflation keeps overshooting baseline forecasts. The trend has continued. If we look at what we just saw last week in ISM business activity surveys, this is from the Institute of Supply Management, the actual economic activity numbers were about as awful gets. Very weak numbers for overall output, for overall sector growth, for new orders, for employment. But where we saw very elevated numbers indeed turned out to be the inflation component. And what we ended up seeing there, if we look at the service sector, it's only a 3-month high. But if we look at manufacturing, it's a 22-month high. So this, at this point, is looking quite a bit elevated and suggests that this kind of outperformance on inflation that we saw in May is carrying over. It's a similar story if we look at what the Fed's models are predicting here. Here is the Cleveland Fed's model of inflation, and they do two versions. They do CPI and they do PCE. This is the CPI one. We can see here that we're still pushing higher, and May, that's that last bar there, is expected to give us inflation at 3.6%. The thing to keep in mind there is that that is north of 3.5% expected to be published when we get those numbers out of the Bureau of Labor Statistics next week. And that, of course, is the next kind of major inflection point on this story after the consumer confidence data over the course of the next session. So this is still suggesting continuation. Let's take a look at what we're looking at here for PCE. Same thing. Inflation expected to continue to strengthen in the next release of this data. So whatever economic inputs are going into the Cleveland Fed's models to gauge this, there seems to be enough evidence here that not only have we had hotter than expected inflation last month, we're on course to have hotter than expected inflation numbers being released this month. Of course, that'll be the April release for those of you keeping score on which the data is coming out. It'll be the April CPI report that comes out next week. And the last one that was released in April was the one covering March, because, of course, data is lagged. It takes time to collate and publish and all these kinds of things. But what we're looking at still here, out through May, is rising inflation. So the model here is saying the April data will have a rise, and then the one after that will have a rise as well. So as we look at this, then, the natural question is, will consumers notice? Now, when we look at what's happening for markets, they actually seem to be less concerned about inflation, because you can see these break-even rates are coming down. So at least from the market's perspective, perhaps they've already done the run-up. Perhaps they've already priced things in. The trend, as we can see, has been up really since late last year. And now we're getting ready to kind of digest and subsume what's already there. Because if we see here, these break-even rates, this is the difference between nominal and real bond yields. So if you look at nominal yields and you subtract inflation, that's where you get the real bond yield. So if you take the difference between the nominal and the real bond yield, you're left with that inflation differential. So you're left with what the bond market is pricing in for inflation expectations. And you could see that from the 5-year, the 10-year, the 20-year, all of them have turned lower, basically within the past month. So at least from the bond market's perspective, the markets seem to be thinking, okay, maybe inflation is rolling over. Maybe this hotter than expected run is not going to be sustained, if only because there's clearly been a hawkish shift in Fed policy expectations over this month. And so when you get 5 years out, 10 years out, you get a lower inflation number because you see policymakers start to signal, yes, we see that the inflation's hotter, we're going to react. But that doesn't really work the same way for consumers. And helpfully, what's occurred here for sort of depth of analysis is the University of Michigan has helpfully, at the beginning of this month, published data on not just what consumers' inflation expectations are, but where they come from. How do consumers actually form their opinion of what inflation is and where it's going? And this is what you find. We can see here that there's basically tall bars here for mainstream news, general internet, so digital news. Personal experiences are the lowest on the table. So it's not as if people are experiencing the inflation that they're ostensibly reporting to pollsters about. The actual inflation that people are seeing out there, not a significant source of how they measure this, at the very least. Word of mouth is a little bit higher. Even the stock market is a little bit higher than personal experiences. But the real standouts are the media that people consume, which you might expect have certainly put out all kinds of headlines. As we've seen, CPI beat forecasts, PPI beat forecasts, PCE beat forecasts. That has surely not been lost in the press coverage. In fact, I've written about it myself. And so what you have here is the likelihood that you've had a month of strong data on the inflation side. It's been hotter. It's been widely reported. And if the people that the University of Michigan is polling tend to get their inflation bearings from mainstream and general news for the most part, well, they've certainly seen that and been made aware. In fact, another interesting chart in this series is a 3-month average of unfavorable news heard about higher prices. Notice here that there was obviously a surge right after COVID. With the disinflation that we've seen, it's moved substantially lower. In fact, at this point, it's less than a fifth of respondents that report unfavorable news that they're hearing about inflation. But notice here, it's getting a bit sticky. This was a very clear adjustment lower, but now we seem to be getting a bit of mud on this chart. It seems to be getting a little bit sticky right around this kind of 10-15% of respondents area, which seems to suggest that maybe inflation concerns are starting to resurface. And the news talking about it more because the data is beating expectations more would certainly explain how that's happening, given where people are getting their inflation guideposts. What this means is that this might well understate how this survey is going to come out. Consumers that have been looking at this data, considering they have indeed been consuming their inflation information mainly from the news, as opposed to actual experience, would suggest that maybe it's not 3.1. Maybe it's 3.2, 3.3. Maybe there's a significant markup of these inflation expectations. Well, what does that mean for the Fed? Surely they are in no position to be cutting anything if inflation expectations for consumers are going the wrong way, because that's exactly the kind of thing that can entrench inflation in the core part of the economy, which is where it's mainly left, the service sector, and derail the Fed's ability to get us back to 2%. And so if there is a hot number here, it probably comes with weaker consumer confidence if the recent pattern holds. But much more importantly, it probably signals to the markets that the Fed has to continue to sit on its hands and that there isn't a big dovish pivot in the works here. And of course, we see what impact that's been having. This is the tried and true chart that we've been looking at here for months, relaying the path of the S&P 500 to the priced in monetary policy outlook. Note here, as we started to build out more rate cuts from late October, early November into the turn of the year, stocks liked it, they rallied. They thought about it at the calendar year turn as the Fed established a baseline saying they, for their part, expected 3 cuts. The market at the time was saying 6. They reckoned that as long as 6 is bigger than 3, that's still relative easing compared to what the Fed has established. That, of course, means that the markets thought the Fed would eventually have to come their way on this. So again, dovish, tailwind, stocks rally. They keep rallying until the market outlook equalizes and goes beyond that of the Fed. At this point, the market is more hawkish than the Fed. So tailwind has turned to headwind. But of course, we just heard from the Fed that perhaps they are going to have less scope to cut, which the markets had already baked in, but that cutting is what they want to be doing eventually. And so if we look at the outlook here, we're looking now at coming off the extremes here, coming off of maybe 25, 24 basis points back to 36, which is telling us 1 cut at 25 basis points and about a 50-50 shot at a second one before year end. And we can see against that backdrop, as this stopped going higher, as the outlook sort of stabilized at this 1.5 rate cuts or so spot, stocks stopped falling and have recovered to basically retest where the breakdown occurred. So if this is sort of the bounds of the break, we've essentially arrived right back at it. And now the question is, well, now what? Do we round off a top here, or do we continue going higher because the Fed outlook has stopped growing more hawkish and is going to build back out this way? If we look at the influence of the U.S. jobs report last Friday, jobless claims today, it's a very parallel kind of thing. Weaker data says we might have room to keep going. There might be the case here for more cutting, but notice this isn't really moving at this point. The markets need to see something on the inflation front, it seems, to really inform this story. And this right here is kind of the decision line. We've essentially reverted back to where this is going to be either a pullback within an emerging down move or a push higher to retest these highs. So if we consider what's going on here then, in the context of this data on consumer confidence, this becomes critical. Because if we get that upside surprise, if consumers do respond to all the news that's been coming out about inflation topping forecasts, because indeed that's the way the data has come out, and that gives us a surprising jump in the 1-year inflation outlook within this University of Michigan survey, yes, it will cool sentiment. It will also signal that the Fed does not have the wherewithal to go from now the market's expectation of 1.5 cuts to, let's say, 2, or even down to their own benchmark of 3. And of course, CPI data is due next week, and this will help to set the stage for it. So if in fact all of this comes together and we get that pop in inflation, stocks might well turn lower from here. Because the idea that the Fed, with this now weaker jobs market in hand, modestly weaker only, but clearly the markets are readily responsive to even, one would think, a trivial adjustment. On the jobless claims, it was 20K higher than expected. On non-farm payrolls, it was maybe 15, 20K worse than expected. So minor deviations. Nothing has really dislodged from its range when we look at U.S. labor markets. But if the markets are prepared to be responsive to that data with such granular outcomes giving such sharp rallies, then it wouldn't take much, given the market's sensitivity, to knock them back if you got something going in the opposite direction. It's the same thing for the US dollar, which, with the stabilizing of the rate cut outlook and the stopping of it pushing into a more hawkish direction, has pulled back. You get a hotter number on this 1-year inflation expectation within the University of Michigan survey, and maybe it recovers. Because we come off 36 basis points and come back to, let's say, 30. Or something a bit closer to 25 than current settings. And then next week we get CPI, and we see if any of those moves find follow through. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things head thereafter. I'm back on with Chris for Futures Power Hour. Typically, tomorrow it'll be with Thomas Westwater because Chris will be out. I'm on with Tom and Victor for First Call on Sundays. Back on with Victor for The Price of Truth on Wednesdays. It'll be Tuesday next week, so watch out for that change up. I am also opining sporadically on the platform formerly known as Twitter and writing for the news and insights portion of tastylive.com, where the abridged version of this very discussion now sits. Thanks very much for joining. Good luck trading out there. See you tomorrow.